Good afternoon, everyone. My name is Didion. I'm the Vice President for Development, Family, and Alumni Relations at Olin College. Thank you for joining and welcome to the Endowment Basics webinar. This is our effort to provide you with information that we hope you will find engaging and informative. Today's webinar is the first in what we hope to be a series of webinars on topics of interest to our community. The presentation will last no more than 40 minutes. After that, we'll be answering questions. You are welcome to submit questions during the presentation by entering them into the Q&A panel. Simply type your question into the dialog box and click the send button. As a reminder, this presentation is being recorded. Our speaker today is Patricia Gallagher, the Vice President for Financial Affairs, Chief Financial Officer, and Treasurer. Patty, we'd love to hear from you.
Great, thank you, Kitty. Hi, everyone, and welcome. As Kitty said, my name is Patricia Gallagher. I'm the Vice President for Financial Affairs and Chief Financial Officer here at Olin College. I've worked at Olin for 9 years, and I've been the CFO for the past 2 years. One of the things that I'm really passionate about is improving the transparency around Olin's financial situation and financial model. But we realize that it doesn't make sense to throw information at people that they don't understand. We need to educate our community first about the components of our financial model, what they mean, and how they fit together. So to that end, one of the things I've done is taught a co-curricular called Follow the Money several times over the past few years about Olin's finances to help the current students understand the different components and drivers of our budget, the endowment, the debt, etc. It's been a lot of fun, and it's been really well received by the students. I do plan to offer that co-curricular again in the fall and probably every year going forward. And we expect that this will be the first of several finance-focused webinars that we'll be offering to parents and alumni. Olin's financial model is somewhat complex, so our plan is to break it down into bite-sized chunks and cover a specific topic in each webinar, rather than trying to cover everything about our finances at once, which would be too overwhelming. We're really excited about this, and we hope this format works and that you find the content useful. We want to hear from you if there are specific topics you'd like to see covered in webinars or through other means in the future. As you know, the topic we're planning to cover today is Endowment Basics. You can see on the screen how we're planning to structure the conversation. And I do want to mention that I'm not going to read the slides to you as I go through them. You guys are all very smart. You can read the slides yourself. What I'm going to do is give you the background, the story, the context behind what's on the slides. As Kitty said, we expect that the presentation will take 30 to 40 minutes, and then we'll open it up for questions at the end. We've got a lot of information to get through, so I'm going to go through some of it fairly quickly, and then we can dive into anything you'd like to discuss in more detail during the Q&A at the end. So why are we talking about Endowment Basics today? Olin's financial model is different than the financial model at most colleges and universities. Most colleges are tuition dependent, meaning that most of their revenue comes from tuition. Olin is not tuition dependent. That's because we have so few students, and also because we provide so much aid to them. As you know, we give every student a merit scholarship equal to 50% of our tuition, and we also provide grants to meet all remaining needs for students who have financial needs. Tuition, net of the merit scholarship and need-based aid, only comprises about 25% of Olin's revenue. So instead of being tuition dependent, we are endowment dependent, which means that most of our revenue comes from the endowment. Today, about 50% of our revenue comes from the endowment. Among colleges, that is probably one of the highest endowment dependencies in the country. So the endowment is very important to us, and it's an important determinant of our financial health. And that's why we decided to start with the endowment for our first webinar topic. So let's start by defining what we mean by endowment. The word endowment can be used in two different ways, and I'm going to use it both ways during the course of this presentation. The first way it's used is when talking about the total value of a not-for-profit organization's investment. When we talk later in the presentation about the investment earnings we've realized on our endowment, we'll be talking about our investment portfolio in the aggregate, which I will refer to as the endowment. The second way the word endowment is used is when referring to an individual's gift fund. The important defining aspect of an endowment fund is that the principal of the fund remains intact. That means that the amount gifted by the donor can never be spent by the organization. Only the earnings can be spent, and the donor indicates at the time they give the gift how they would like the earnings spent. The use of the earnings can be unrestricted, which means the organization can use it wherever it's needed most, or the use of the earnings can be restricted to a particular purpose, such as financial aid. As I mentioned, the principal or the original gift remains intact forever, providing a permanent income stream for the organization. And if it's invested smartly and the organization is prudent about how they spend the earnings, the income stream can grow over time. So let's start by talking about why endowments are important to not-for-profit organizations. We'll do that by using an example, and in this example, we'll look at a hypothetical individual gift fund and how it can grow over time. So in this example, a donor or a group of donors makes an endowment gift of $100,000. The assumptions we're using for this example are that the endowment fund is invested and the average investment earnings over time is 6.5% annually. We further assume that the fund spends 5% of its value each year. Finally, we assume that the donor indicated at the time they gave the gift that they wanted the earnings restricted to be used for financial aid. Admittedly, this is an oversimplified example, and the actual reality would be slightly more complicated, but it'll help us illustrate how an endowment works. So what happens? Well, after 10 years, the fund has grown from $100,000 to $116,000, and the college has been able to award grants of $53,000 to students. Pretty good, right? It's like planting an acorn and seeing it grow into a tree. Now let's play it out a little further. After 25 years, the fund would be worth $145,000, and grants of $150,000 have been paid out to students. Finally, after 50 years, the fund is worth $210,000, and grants of $368,000 have been paid out. And that's all from one original $100,000 gift. So you can see the power of an endowment. It creates a steady income stream for the future, and as long as the earnings exceed the spending, the income stream will grow over time. Now let's look at that same example again, but let's make one small change to our assumptions. Let's assume that in addition to the gift of $100,000 that created the endowment, a small amount of additional gifts are added to the endowment over time. Let's see what the impact is of just $5,000 per year in additional gifts. After 10 years, the fund would now be worth $170,000 versus the $116,000 from our original example, and grants of $65,000 would be awarded versus the $53,000. Here you can see the impact after 25 and 50 years. So let's look at the numbers after 50 years. The fund value is more than doubled from our previous example, and the grants awarded have also doubled. That's all from just a $100,000 gift and $5,000 per year in additional gifts. It really can have a big impact. So as we saw in the examples we just discussed, there are three factors that impact how fast an endowment grows. Number one, we saw the dramatic impact that new gifts can have. New gifts obviously increase the value of an endowment. Number two, spending decreases the value of an endowment, so you don't want to spend too much. In our hypothetical example, we spent 5% per year. And then number three, investment returns can either increase or decrease the value of an endowment, so it's important to invest prudently and try to maximize your returns and minimize your losses. In our example, we assumed 6.5% annual return. This is really important, and it really is this simple. From a big picture perspective, these are the basics for how to manage an endowment. These are the three levers that you can pull. You try to maximize the positive impact and minimize the negative ones. So now I'm going to spend a few minutes drilling into each of these factors individually. We'll start by talking about new gifts. But before we dive into new gifts, let's set the stage by talking about how much Olin has today in endowment funds. As you know, the largest endowment by far is the Olin Endowment. That is the money that was given to us by the Olin Foundation when the college was founded. That money was given in order to build the campus, run the college, and support the budget. The value of the Olin Endowment as of February 28th, which is the latest value we have, is about $370 million. But we also have several other smaller endowments, which serve some very important specific purposes. You can see here a summary list of the other endowment funds that we hold. Some of them were class gifts, some of them were gifts from individual donors, and others were funds that many people donated to. You can see here the value of each type of fund grouped by the nature of the restriction on the use of the earnings, and you can also see the annual spendable revenue generated by each type of fund. We'll talk more about spending in a few minutes. So let's look at an example here. If you look at the fourth line down, it says library. You can see that we have two funds whose earnings are restricted to be used to support the library. The market value of those two funds as of December 31st was $260,000, and they generate about $13,000 in spendable revenue per year. That's $13,000 that the library can use to purchase books and other supplies over and above what they have in their operating budget. So now let's get back to the topic of new gifts. This graph shows endowment gifts received by Olin over the last several years. This includes gifts to the Olin Endowment, as well as gifts to the other smaller endowments that we just looked at. The good news is that the level of endowment gifts has risen in recent years. The bad news is the number is still relatively low. For a $370 million endowment, gifts of $300,000 per year barely moves the needle as far as helping the endowment to grow in a meaningful way over time. So let's talk for a minute about what it takes to establish an endowment fund at Olin. Our minimum threshold is $25,000 for an endowment. At a 5% spend rate, a $25,000 endowment would generate about $1,250 in spendable revenue per year. That's not a whole lot of revenue, so we do prefer to see larger endowments that can spin off more revenue and have a more meaningful impact. For the existing endowments that are already in place, gifts of any amount are always welcome because, as we saw earlier, additional gifts to existing funds can really help improve the power of the endowment to help the college. So now let's switch gears and talk about spending. We'll start by talking about the Olin Endowment. When the Olin Foundation gifted us the money, it came with some strings attached. Those strings are outlined in the endowment grant agreement, which dictates how much of the gift the college can spend every year and for what purposes. And it also sets a maximum spending rate of 6% per year. Every year during the college's budget process, the board takes into account the maximum allowable spending rate of 6%, along with the cash needs of the college and our other revenue sources, and uses all of that information to set the budgeted spending for the year. I think most of you have seen this chart before. We used to show it at every town meeting after the financial crisis in 2009, but I'm going to spend a few minutes explaining what it is and why it's important. Most endowments use what's called a spending formula in order to calculate their allowable endowment spending for each year. Spending formulas attempt to minimize volatility in spending from year to year. That way, sharp changes in the value of the endowment don't result in unexpected spending implications for the organization. It's basically a smoothing mechanism. Olin uses a spending formula based on the value of the endowment investments for the prior 12 quarters. The graph shown here is referred to as our 12-quarter trailing average graph, and it shows the actual value of the endowment in blue and the 12-quarter trailing average in red. Each red dot is simply the arithmetic average of the 12 blue dots that precede it. The budgeted spending rate for each fiscal year is based on the 12-quarter trailing average value as of the previous December 31st, which is signified by the large red square. So, for example, spending for the fiscal year that ends June 30th, 2018, which is next fiscal year, will be based on the 12-quarter trailing average value as of December 31st, 2016, which is the red square on the far right. That red square is the average of the 12 blue dots immediately before it. So we take the value of the large red dot, we multiply that by 6%, and that's our maximum spending rate for fiscal 18. For the other endowment funds, that is other than the Olin Endowment, we also use a 12-quarter trailing average spending formula, but we have a fixed spending rate of 5% every year. College policy is that we do not allow spending from an endowment fund that goes underwater. Underwater is the term that is used to describe an endowment whose investment value has dropped below the amount of the original gift. In other words, the investment has lost money. The reason why we don't allow spending from underwater funds is because we feel that spending from the principal would be contrary to the wishes of the donor, who explicitly wanted their original gift to be left intact. The law does allow not-for-profit organizations to spend principal of endowment gifts in certain circumstances. Nevertheless, we feel it is prudent not to spend from underwater endowment funds, so that's our policy. The law I'm referring to that governs the spending, investment, and oversight of endowments is known as UPMIFA. That law basically provides the guardrails within which we and all endowments must operate. So what we're showing on this slide is the historical spending rate for the Olin Endowment, which is shown by the blue line. Again, the Olin Endowment is used to support the Olin budget and basically pay for any expenses for which we don't have other revenue sources to cover. Because our other revenue sources are limited, and we're not tuition dependent like most colleges are, our endowment spending is higher than other colleges and also higher than we'd like it to be. In a perfect world, we would be spending less than 5% a year from the endowment. 5% a year is the informal rule of thumb for the maximum spending to maintain the purchasing power of an endowment. But instead, we're spending somewhere in the mid-5s. You can also see the gray line, which shows the average spending rate for other college and university endowments. You can see that most college endowments spend on average somewhere in the mid-4% range. As we mentioned earlier, most colleges are tuition dependent, so endowment spending is not a huge revenue stream for them. The average college gets less than 10% of its revenue from the endowment versus 50% for us. That low dependency enables them to spend at a rate that's more sustainable than what we're doing. The spending rate shown here on the top graph is the exact same data that we saw on the previous slide. It's just presented in a bar graph versus a line graph. Below that, we can see the dollars drawn from the endowment. It's interesting to see that in some years, such as 2009 to 2012, the spending rate was going up, but the dollars coming from the endowment to support the budget was going down. That's because the 12-quarter trailing average that we saw a few slides ago was declining during this period, so we were taking a higher percentage of a lower base. So now let's spend a few minutes talking about how we manage the endowment. Olin uses an outsourced chief investment officer model to manage its endowment. What that means is that we hire an outside firm to manage our investments instead of hiring internal staff to do so. We do that because we feel we can get better performance at a lower price. Experienced chief investment officers are very expensive to hire, and we think that this is a better model for us. We get the benefit of great expertise that we could never afford ourselves to have on staff. The Olin Board of Trustees makes the ultimate decisions about how to invest the endowment. The board has an investment committee, which is comprised of 4 trustees and 2 non-trustee outside experts, and that committee meets at least quarterly to review investment performance, talk about what's happening in the market, and make decisions regarding any changes that might need to be made to the portfolio or its management. The outsourced CIO, which is in our case a firm called Summit Rock Advisors, makes the day-to-day tactical decisions about what to invest in, what changes to make, etc., within the guidelines and constraints provided by the investment committee. Summit Rock Advisors has a certain asset allocation that they must adhere to, which was approved by the board, with ranges that allow them to have some flexibility within asset classes. Summit Rock is a small firm based out of New York City who oversees about $11 billion in assets, primarily for endowments, foundations, and private families. Most of their clients are in the $300 to $400 million range, so they're a good fit for us. We've been with them since 2012, and so far they've done a good job for us. Our internal staff here at the college, which is me and my team, does all of the accounting for the investments, oversees the work of Summit Rock, and authorizes all money movements. So you can see that it really is a team effort, and this model works really well for us. When I talk about asset classes, what I'm referring to are the different types of investments that we invest in, or the slices of the pie shown on this slide. What you can see here on the left side is the broad asset categories. In aggregate, we have about 15% in bonds or fixed income securities, 25% in hedge funds, and 60% in stocks or equity type investments. And then we can drill into that further on the right-hand side to show the specific asset classes within each broader category. This is a pretty typical asset allocation for a college endowment of our size. So let's talk for a minute about why we have a diversified portfolio. And when I say a diversified portfolio, what I mean is, why do we slice up the pie on the former slide into so many different asset classes? Why don't we just put our entire endowment into an index fund of the S&P 500 and just get the market rate of return? Well, we don't do that because we don't think it would be very responsible, and I'll explain to you why. Different asset classes, or different types of investments, have different expected rates of returns and different risk profiles. In general, risk and return are positively correlated. So the riskier an investment in general, the more you can be expected to return. That's been borne out over time, but of course, as they say, past results are no guarantee of future performance. When an investment has low risk, that means that there is a narrow band of expected return. For example, bonds, or fixed income securities, can be expected to return very low, but generally positive rates of return. In today's market environment, you're lucky to get a few percentage points from bonds, but you can be pretty sure that you won't lose your money. Now, we don't put our entire portfolio in bonds because we wouldn't earn enough to cover our spending rate. But it's a nice, stable investment that protects us from losses, so we definitely want some of that in our portfolio. On the other end of the spectrum, stocks and other equity-type investments have the highest expected returns, but they also carry the highest levels of risk. You can potentially earn a lot, but you can also lose a lot, and we can't afford to lose the endowment. But in order to try to get returns exceeding our spending rate, we need to take some risk and invest in some riskier asset classes, such as private equity, venture capital funds, and other stock-type investments. But we also need to balance that with some safe and stable investments like fixed income. And then there are a number of different choices in the middle, such as hedge funds with more moderate expected returns and more moderate risk. Mathematically, it's been proven by people much smarter than me that the best way to maximize your expected returns is through diversification, or investing a little bit in each asset class. So how has our endowment actually fared in the market? Well, here you can see our actual performance results by fiscal year. You can see that we've had some really good years and some not so good years, which is to be expected when you're investing in the market. Now let's put that into perspective and see how our performance compares to that of our peers. What we can see here is Olin's performance in light blue versus the average of most other college and university endowments in light gray, and also versus a subset of that data set, namely college endowments of our size, so $100 to $500 million in dark blue or black. You can see that the three lines track very closely with each other, so closely that you can't even tell there are three lines in many places because they're overlapping at so many points. The takeaway here, which is really important, is that our returns are right in line with those of our peers. Everyone is using similar asset allocation strategies, so there's not a lot of variation in the average return. Here we can see the value of Olin's endowment over time. In the early years, it was increasing with new gifts from the Olin Foundation. Then you can see it took a big hit in 2009 during the financial crisis, and it's been hard to recover since then. We're basically holding our own, and that goes back to the idea that we have very few new gifts coming in and heavy spending going out. In order to grow the endowment, we need to figure out how to increase new gifts and/or decrease spending. In the early years of the college, we were very dependent on the endowment. That was intentional because the thought was that the endowment could sustain that level of spending indefinitely. We thought that we didn't need fundraising. As many of you know, Olin didn't even have a development department in the early years. And we also thought that we didn't need tuition revenue. And then the financial crisis hit, and we realized that our strong dependence on the endowment was like a one-legged stool, which was very unstable. And we realized that we needed more financial stability with other revenue sources. So over time, as you can see here, we've been able to bring down our dependence on the endowment to about 50%, which is great. Here's another view at the changing dependence on the endowment. You can see that our total revenues have not grown much over the past 10 years, but the proportion coming from the endowment in blue has decreased as the other sources have gone up. So finally, let's finish by looking at a few examples of some successful endowment funds at Olin. Recently, a new need-based aid endowment fund was established by a donor. This fund will help offset the cost of need-based aid provided to Olin students. We provided about $2.5 million in grants last year to needy students. That's more than 10 times what we provided just 7 years ago. And our budget for next year is $3 million. We continue to be need blind in our admissions, and other than a small self-help component, we meet full need with grants, which is rare. Most colleges meet need with loans or a combination of loans and grants. And then finally, our last example is the Alumni Merit Scholarship Fund that was established a few years ago by a group of our alumni. This fund has the lofty goal of reinstating the full tuition merit scholarship for all Olin students. The fund tapped into the incredible passion that our alumni, especially those from the early classes, have for the value of the full tuition scholarship and the desire to eventually reinstate it. In just a few years, we've raised over $200,000, and the fund has now been endowed. Thanks to this fund, for the past 2 years, we've awarded every second semester senior a $75 scholarship as a first baby step towards reinstating the full tuition scholarship. The hope is that as the fund grows, we'll be able to increase the amounts awarded and also increase the number of students who are getting it until the point at which all students will once again be receiving the full tuition scholarship for all 4 years. In the meantime, we're a very, very long way away from that, but at least now we've got a vehicle in place for the people who are really passionate about this, and we're making progress. And that's the end of our formal presentation. Thanks for sticking with us. We know it was a lot of information, and I went through much of it very quickly in the interest of time, but we wanted to have plenty of time at the end for questions. So we're going to open it up for questions now. Kitty and Alana, do we have some questions?
Yes, we do, and thank you, Patty, for the very stimulating presentation. I want to encourage participants to submit their questions by entering them in the Q&A panel on your website for the webinar. And the first question we have, Patty, I think is an interesting question, and it is, how are the endowment investment goals different for Olin compared to other colleges that do not depend upon the endowment as a primary source of income? So how are investment goals different, or how do we have to handle the fact that we rely so heavily on our endowment for the work that we do at Olin?
Yeah, that's a good question, and our asset allocation and how we invest the endowment is a little different because of our high dependency. So we can't afford big losses in our endowment. So we invest a little more conservatively than most colleges and universities do who aren't as dependent on the endowment. So we probably have more allocated to fixed income bonds, safer securities like that, and less to the riskier asset classes because we just can't afford to take that much risk.
Good point. Here's a question from a listener. Hypothetically, if the Alumni Merit Scholarship Fund raised its full goal, would the need-based aid fund still need to exist?
That's a great question. I would say yes, because the full tuition scholarship just covers tuition, not room and board. So we would still need the need-based aid to cover any need related to the room and board.
Okay, and then I have another question here from a listener. Why is $25,000 the minimum to create an endowment?
Good question. Most colleges have a higher limit to create endowments. I think we made it lower because we wanted it to be a little more accessible. But most colleges have a higher limit because they realize that a larger endowment is going to spin off more spendable revenue and have a more meaningful impact.
So here's another question that kind of follows up on that. If I choose to donate for a specific project, how will I know that the funds I donate will go for that project?
Sure. There's a lot of oversight here internally on gift funds. So my staff gets a copy of every gift agreement for every new gift. We monitor the gifts and the spending to make sure that it's in accordance with what was indicated by the donor at the time they gave their gift. So there's quite a bit of oversight here to make sure that gifts are spent in accordance with donor restrictions. And then we also have external auditors who come in at the end of the year, and they'll do a sampling of the gift funds to make sure that everything was in line with what the donors.
So I just want to reassure listeners that very much what you donate your funds to for Olin is what it will go to. And there's another follow-up question about this. Is what if the assumptions being made about the endowment's rate of return are not accurate? What then happens? What does Olin do to respond to that?
Well, I can tell you the one thing that we know is that our assumptions will not be accurate. We know that returns are going to be high in some years, low in other years. We assume an average rate of return, but we know that that's not what's going to happen. We will react, as appropriate to make sure that we have sufficient resources to manage the college's budget. We're constantly looking at the asset allocation to make sure that it's prudent for what we need to do. And
good. So here's an interesting question. If we are having to have our funds invested on the conservative side to minimize risk for the reasons you just explained, why do we then track so closely to other colleges in our endowment range based on that slide that you showed earlier? I don't know if you want to go back to that slide that shows the gray and the blue. But there's some curiosity from some of the listeners. If you look at investment returns versus peers, we're very much aligned, yet we know we're having to invest on the conservative side. So they're curious about that.
I would say we're doing really good with the rest of the investments.
Hopefully that answers that listener's question. And this is a question I think that's kind of interesting when we think about this is, part of the challenge we have is we have the need for spendable gifts to go to work immediately, like need-based aid. So we just, had Canada this weekend not too long ago and offered opportunities for students to come to Olin. And we have, right now, roughly 100,000 still needed in financial aid for next year for some of these students versus endowments. So part of the question, I guess, is, from your perspective and then maybe from my perspective, what's that right balance between growing the endowment, which is such an important engine for the future of Olin, versus income for immediate needs?
It's a great question, and both are important. I can't say that one is more important than the other. Spendable gifts are important for today to make sure that we have, the proper funds to support today's budget. But the endowment is going to help the students of tomorrow. It's something that we refer to as intergenerational equity. So you don't want to benefit tomorrow's students at the cost of today's students, or vice versa. You don't want to benefit today's students at the cost of tomorrow's students. We want to benefit them all equally. So both the current gifts and the long-term endowment gifts are important.
I think that's very well said. I don't think there's much more I could add other than saying we know that there's some immediate needs that the Olin community has. We try to address those both for faculty and students and facilities such as equipment, as well as knowing that we want Olin to be a place that is innovative and continuing for all of our grandchildren and beyond. So looking at that mix is very important. I have a question that kind of builds on that is, if you could choose, you talked about how the dependence on the Olin Endowment has gone down from 80% to roughly 50%. But do you or your colleagues who work on this for us have a sense of what would be an ideal percentage of reliance on the endowment that would make sense for the future?
Yeah, I don't have a magic number. I think it's got to be less than 50%. The major sources of revenue that we've got are the endowment, philanthropy, tuition, and then there's all other sources combined. I think in a perfect world, it would be sort of, all four of those buckets would be more or less equal, so that you'd have, equal dependency on each without any strong reliance on any one.
So what I'm hearing is that having reliance on just one thing, no matter what, it might be an endowment, an individual donor, or whatever, what Olin's trying to do is diversify and have it support in such a way that we can plan on it and we can be able to be committed to the resources we need to do the important work we're doing. So we have a follow-up question to the previous question. So I'm going to read the first question and then ask you the follow-up question. So recently a listener asked if we're having to have our funds invested on the conservative side to minimize risk, why do we track so closely to other colleges or endowment range? And you explained that you thought part of it was we were doing an excellent job and worked hard on that. And the follow-up question is, does this mean that because we track so closely that potentially our peers are also investing conservatively? So I'm wondering to what extent you know some of the investment strategies and some of the peers that are on the slide, or what you can share. And this is obviously your perspective.
That's a great question. It's not something I've really drilled into, so I'm not sure I can give a good answer on that. I'm not sure I can really answer that.
So I think it's interesting to think about to what extent peer institutions benchmark against each other. And I think you and colleagues here at Olin do spend time having conversations with other institutions and trying to learn what are some of the strategies that they're using. And there probably is some emulating from all the institutions of what seems to be working well.
Yeah, I think the asset allocation that we use is fairly similar to what other colleges use. I think ours is a little bit more conservative. And some colleges do it themselves. They have staff on employed by the college that invest the money. Some use outsourced chief investment officers like we do. Some use consultants. So there are a number of different strategies that are used by different colleges. But at the end of the day, there's some dispersion around the mean, but we fall very close in line with the averages.
Another listener wants to know if they were interested in creating a scholarship. Who would they contact?
They would contact development, you and your team, Diddy.
So if anyone is interested in either supporting an existing scholarship, some of them that Patty highlighted, as well as new scholarships, we would love to hear from you. And I want to just, again, encourage listeners, if they have questions, we will do our best to answer all of them, both at this webinar, and we can also do some follow-up answers as well. And to let you know that we plan to make the slide deck of the audio as well as the presentation available on the Olin YouTube channel. So I think that another question that was asked, and I think this is kind of interesting, is if for some reason the endowment happens to be growing at the returns at a rate that's not expected, let's say going back to the investment returns of like 2011, how would that change your planning in the future? If we were to define the growth, let's say from 6-7 years ago.
Yeah, if we had a few really good years, I think that would just sort of take some of the pressure off. It would allow us to be more innovative, to do, to be more creative and innovative, and just to do more without, sort of having, the pressure of constrained budgets.
So I think particularly for an institution that wants to be innovative, that where all the curriculum has an expiration date, it gives you a little bit more agility to try things that may or may not work because you have that freedom to do that. Patty, would you mind going back to the slide with the tree and the acorn where 5,000 was added per year? Because to me, I think one of the things when we think of the word endowment, we often think of very large sums of money, which of course they can be, and of course the development office would be glad to talk to friends in the community about that. But I think what's interesting also is to think about how 5,000 per year can have such an impact on the fund, and to be thinking about to what extent where we want Olin to be in 2 or 3 decades from now. It's really important for us to be planting those acorns right now. And I was wondering some of your thought about that, or if you've seen that happen with some of the endowments that have started to grow. You gave the example of the library and how they have 13,000 now more that they can expend in their budget. But I think just maybe reiterating that what we're also talking about is having that steady income over time makes a huge difference in what we can do as an institution.
Yeah, I mean, I think every gift matters no matter what amount of the gift, and this just shows the big impact that small additional gifts can have.
True. So I think it's really important. And the other thing that's nice about this is it allows, again, to be for a very specific interest of the donor that fits the needs of the college and allows that as well. I think that unless I'm misunderstanding, this might be our final question to ask this, but I think it's just understanding better. Part of the difference or the importance of the Alumni Merit Scholarship Fund is very important. It's very important to our community of alumni and the whole community. But I think if you go back also to the need-based aid, just the fact that we now have had a tenfold increase in the need for need-based aid means that this is what the difference is for Olin is because we give grant aid. I think if you can just reinforce this or explain it again, this is something our community is very interested in, and alumni I think would like just to have it reinforced one more time, if you wouldn't mind.
Sure. So we meet full need for all students who have financial need. Other than a $3,500 self-help component, we meet 100% of the need. And we do that with grants, not with loans, with grants. Most colleges, I'm not aware of many colleges at all that do all grant aid. Most do a lot of loans, maybe a little bit of grants, but we do all grants. And yeah, I mean, we're budgeting for $3 million in need-based grants to students next year. So it's a good part of our budget.
And I think the other important thing to note is this is a commitment when you make it to a student for their tenure, their time only. So this is something where we make that commitment, well, in terms of scholarships or programs that we try to do, we need that money before they come, correct? For the need-based aid, we need it this year, but giving out the aid for the following year. So it's not aid that we can get during the time. We really need to have some of that before they come their first year, if I understand correctly.
Yes.
So we need a little planning in terms of being able to make those commitments that we make because they impact the draw on the endowment.
Yep.
So I think we would say both the Alumni Merit Scholarship Fund and need-based aid are two areas where we can make a huge difference on who can attend Olin, who our future leaders are in terms of innovation engineering because of Olin and the diversity and the inclusion of the Olin community. And I think this is an area that I would love to hear from those who are listening and get their ideas on what we can be doing different. So I think that there are no additional questions. I think we're going to go ahead and close today's webinar. Patty, thank you. This was really informative. I think many of us have heard the term endowment and maybe didn't always understand exactly what it was, but you've given us a great, better understanding of the commitment Olin has to shepherding its endowment. And we hope that those of you who listened, thank you for joining us today. We hope that you found it useful. And again, we'll be posting the audio and the slides on the Olin YouTube channel. Thank you.